Let me call this hearing to order. Let me thank the ranking member, Lindsey Graham, for his help. And let me thank our colleagues on the committee and our witnesses who will be testifying remotely, almost all, not all, this morning. Right now, there is a vote that has been called. It'll be the first of 4 votes. So I think you're going to see members moving in and out. Last week, as some may recall, the Budget Committee held a hearing on income and wealth inequality in America. We talked about the economic absurdity of 2 people in this country, Jeff Bezos and Elon Musk, owning more wealth than the bottom 40% of the American people. 2 people owning more wealth than the bottom 40%. We talked about the obscenity of the 50 wealthiest Americans owning more wealth than the bottom half of our society, 165 million people, while over 90 million Americans are uninsured or underinsured, unable to go to the doctor when they need. Talked about the absurdity of the top 1/10 of 1% owning more wealth than the bottom 90%, at the same time as 500,000 Americans are homeless and children in our country are going hungry. We talked about the fact that over 650 billionaires in America became $1.3 trillion richer during the pandemic, while 63% of Americans have been living paycheck to paycheck, worried that if their cars break down or their kids get sick, they're going to be in financial disaster. Today, in the midst of massive wealth and income inequality, this hearing is going to talk about the need to end a corrupt and rigged tax code that has showered trillions of dollars in tax breaks to the wealthiest people in our country and the most profitable corporations. Warren Buffett, one of the very wealthiest people in America, is right. Buffett is right. We can no longer tolerate a tax code that allows him, worth $95 billion, to pay a lower tax rate than his secretary. We can no longer tolerate many large corporations making billions of dollars a year in profits, paying nothing, zero, in federal income taxes, while at the same time, half of older Americans have no retirement savings and no idea about how they'll be able to retire with dignity. According to recent studies, in America today, the top 1% is responsible for 70% of the taxes that go unpaid each year. In other words, the top 1% is evading some $266 billion in federal taxes each and every year. And even in Washington, that is a tidy sum of money. If we collected just a third, 1/3 of the unpaid taxes of the very rich, we could provide in this country and make public colleges and universities tuition-free, provide universal school meals to every child, and guarantee clean drinking water to every person in our country. And that's because the people on top have underreported some 20% of their income. Despite what some of my Republican colleagues may claim, the reality is that when you take into account federal income taxes, payroll taxes, gas taxes, sales taxes, and property taxes, i.e. the entire tax system, we have as a nation an extremely unfair tax code that allows billionaires to pay a lower effective tax rate than public school teachers, truck drivers, and nurses. And that has got to change. We need a progressive tax system based on the ability to pay, not a regressive tax system that rewards the wealthy and the well-connected. Let us be clear, as I think all of us know, this country faces enormous structural crises that we must address. Everybody understands that our infrastructure is crumbling. That is our roads, bridges, dams, wastewater plants, sewers, culverts, and yes, affordable housing. That's going to take a lot of money to rebuild our crumbling infrastructure. In order to combat climate change, which is an existential threat to our planet, we need to fundamentally transform our energy system to make it energy efficiency and to build sustainable energy systems. Also an expensive proposition. Further, we need to do what every other major country on earth does, and that is to guarantee health care to every man, woman, and child as a human right, not a privilege. We need to make sure that all of our children, regardless of their income, are able to get a higher education if that is what they desire. We need to expand, not cut, Social Security so that 20% of our seniors are no longer forced to survive on an income of less than $13,500 a year. Now, I think as many people know, as a result of the Trump tax cuts for the rich, in 2018, over 90 Fortune 500 companies not only paid nothing in federal income taxes, they actually received billions of dollars in tax rebates from the IRS. Profitable corporations pay nothing in federal taxes, get a rebate from the IRS. For example, just a few examples. 2018, Amazon received a $129 million refund check from the IRS after making $10.8 billion in profits. Delta received a $187 million refund check from the IRS after making over $5 billion in profits. Chevron received a $181 million refund check from the IRS after making $4.5 billion in profits. And this gross unfairness never ends. Recently, as many know, some of my Republican colleagues introduced a bill to give a $1.7 trillion tax break to the 650 richest families in America, families who are now worth over $4 trillion. So in the midst of all of the problems facing our country, some of my Republican colleagues have decided that what we should do is give massive, massive tax breaks to the very, very wealthiest families in America, the top 0.1%. For example, under this effort to completely repeal the estate tax, which some of my Republican colleagues are talking about, the Walton family, the richest family in America, and the owners of Walmart would get a tax break of up to $88 billion. Got that? Richest family in America, under the repeal of the entire estate tax, will get an $88 billion tax break. Family of the wealthiest individual in the world, Jeff Bezos, owner of Amazon. Complete repeal of the estate tax would mean that that family would receive a tax break of more than $70 billion. Meanwhile, under that plan to completely repeal the estate tax, over 99.9% of families in America, including every family farmer, rancher, and small business owner, would get nothing, not a penny in tax relief. Why? Because the estate tax repeal only applies to people who inherit over $11.7 million in wealth. Well, needless to say, I have a very different perspective, and that is why I am introducing today an estate tax bill with Senators Whitehouse, Gillibrand, Reed, and Van Hollen that would do exactly the opposite of what my Republican colleagues would do. It would demand that the families of the billionaire class not only not get a tax break, but start paying their fair share of taxes. And by the way, interestingly enough, when we talk about the estate tax, I hope my colleagues understand this is not an idea invented by Bernie Sanders or some other progressive. It was an idea developed, created by a good Republican named Teddy Roosevelt. And as Teddy Roosevelt said, quote, and this is an important quote because it's relevant today as it was back then. Roosevelt said, "The absence of effective state and especially national restraint upon unfair money Unfair money getting has tended to create a small class of enormously wealthy and economically powerful men whose chief object is to hold and increase their power. The prime need is to change the conditions which enable these men to accumulate power. Therefore, I believe in a graduated inheritance tax on big fortunes, properly safeguarded against evasion, and increasing rapidly in amount with the size of the estate. End of quote. Teddy Roosevelt, Republican. And Roosevelt was, of course, exactly right. Further today, I'm introducing the Corporate Offshore Tax Dodging Prevention Act, legislation that would prevent corporations from shifting their profits offshore to avoid paying U.S. taxes and would restore the top corporate rate to 35%, where it was before Trump became president. Today, corporations are avoiding hundreds of billions of dollars in taxes by shifting their profits to offshore tax havens in the Cayman Islands, Bermuda, and other locations. Interestingly, in 1952, corporate income taxes amounted to 32% of all federal revenue. Today, that figure is down to just 7%. So here's the bottom line. We're living in a country which has enormous needs, have a very large deficit, and yet we have a tax code which enables the very, very richest people in America and the largest corporations to avoid paying their fair share of taxes. That has got to change. And with that, I am happy to give the mic over to my colleague, the ranking member, Lindsey Graham.
Thank you, Mr. Chairman. These debates are very worth having, well worth having. In 2017, we did in fact cut taxes. We cut taxes in a way to make American corporations competitive with a worldwide rate. What happened before COVID? You saw a rise in wealth among every segment of the American family. Latino and Hispanic household incomes increased. African American incomes increased. Women's income increased. We added 5 million jobs. People benefited mightily. What happened after that is that 19%, the top 1% account, I think, for 19% of all wealth in the country. They pay 40-something% of income taxes. 35% of the people in the United States don't pay any income taxes. And so I think a model of increasing taxes now in the name of going after the wealthy hurts the middle class as much as it would hurt anybody else. The one thing that I differ with Senator Sanders is that we live in a world that's very competitive. If you go to a 35% corporate tax rate, you're going to incentivize people in the wrong way to find locations that are more friendly. Why are we doing so well in South Carolina? Because we have a low business-friendly tax structure, hard-working people with a good education system to help them acquire the skills they need to work in a modern economy. That's why BMW, Michelin, and Boeing, I could go on and on and on. The premier manufacturers in the world have chosen my state because of a good workforce and good sound tax policy. To those who are listening out there, tax policy is job policy. The way you structure your tax code is going to determine how competitive you can be vis-a-vis the rest of the world. And if you want to declare war on the top income earners in this country because you think they have too much because they don't pay their fair share. Well, what is a fair share? Reader's Digest has been doing polling on this issue for decades, and most people say around 25 or 30% is a fair share of anybody to pay. What Senator Sanders doesn't get, in my view, is most people who are struggling to make it out there would like to be wealthy and don't resent people who are wealthy who've done it right and fairly. So when the government's going to determine how much you can make, what the ratio should be of what a CEO can make in any company, what else are we going to do? So the bottom line is that free enterprise works. The model you're proposing has been followed throughout the world, and it crashes and burns over time. I'm not advocating eliminating the death tax, but I am advocating making it possible for people who worked all their lives to pass wealth to their families. And when Bill Gates' times comes, I think he's done a good job with his money. I don't want the government to grab all of it at the end. This insatiable desire by my friends on the left to grab as much money and power as they can is going to ruin the country. There has to be some balance that I do believe in a progressive tax code, but every time we meet, we're talking about another group of people in America to grab their money to do things with that politicians like on the left. And we'll see where this goes. We're going to have an election in 2022, and I want everybody in South Carolina to know that if Senator Sanders gets his way, it's going to be hard for corporations to remain competitive in our country. The reason people are leaving New York and California in droves to come to where I live is they're making it impossible to do business there. And we're not going to do that to the country with the Republican votes. I think our tax cuts in 2017 were well designed. They benefited everybody in the country, and we will fight you appropriately and respectfully as you try to rearrange America in a fashion that I think is contrary to what we stand for as a country. A debate worth having and a fight worth engaging in.
Thank you, Senator Graham. We have some wonderful witnesses today. And let me begin with Abigail E. Disney. Ms. Disney is the CEO and co-founder of Fork Films, chair and co-founder Level Forward. She is a filmmaker, philanthropist, activist, and an Emmy-winning director. Ms. Disney is the granddaughter of Roy O. Disney, co-founder of the Walt Disney Company, which makes her an heiress to the Disney family fortune. Ms. Disney, thank you very, very much for being with us.
Thank you, Senator Sanders, and also thank you to Ranking Member Graham for letting me come and testify for you here today. I grew up with one of the most recognizable names on earth in a family that went from dirt poor to embarrassingly wealthy in 2 generations. My grandfather managed to accumulate a large amount of wealth in a tax environment some now call punitive. He built a series of wildly successful businesses, despite negotiating with highly empowered unions who had support from the federal government. He managed to navigate a regulatory environment many now describe as draconian. Somehow, he managed to do all of this, despite living under conditions that many rich people now would claim would make their lives impossible. The commonly held image of the wealthy as being ungenerous and elitist is, I'm sorry to say, completely consistent with my own experience. The bubble it creates can be self-affirming, and poverty, hard work, and struggle become a distant and exotic experience meant for other sorts of people. You can start to believe that you are admirable because you have money, and you have money because you are admirable. And this mythology of relative merit conveniently supports doing nothing about the unfair structures advantaging a handful of people. They're supported in this delusion by a political system that needs your money more than it needs to fight for its constituents. We have gone so far down this rabbit hole to hell that we have lost touch with some common sense notions, like that those who have benefited more from society should pay more for its upkeep, or that a profitable company is not built as much by executives as by its workers. One place to start to right this wrong is by changing how we tax people like me, who inherit huge sums of money and pay less in taxes for owning things than most Americans pay on the money that they earn by working. That's why I support the 99.5% Act and equalizing capital gains and earned income tax rates. Some senators have recently proposed repealing what's left of the estate tax, which would do nothing but reward people who lucked into the American dream just by being born into wealthy families. As if inheriting money wasn't advantage enough, I'm able to use it entirely to live by living off of investments. And thanks to the capital gains tax rate, I pay half the tax rate of people who are working for a living. It's time to stop rewarding people who make money simply by having money. Lately, I've made myself obnoxious by pointing out that the CEO at the company that shares my name shouldn't earn 1,400 times what his average worker makes, or more than 2,000 times what his lowest paid worker makes. I am not against a person making a lot of money per se, but if you do so while people who cash paychecks with your name on them are skipping insulin, or in one heartbreaking case, dying while sleeping in their car, it's only common sense that a larger share of profits would be better deployed to make sure your employees can meet their basic needs. Of course, Disney is not the only company overpaying its CEO, and it's not even the worst. That's why I support a higher minimum wage, because there is such a thing as not enough. But I also support Tax Excessive CEO Pay Act, because there is also a thing as too much. In 1970, a CEO, and that would have included my grandfather, got paid roughly 20 times what their typical worker was paid. Today, the average CEO makes about 320 times. This is absurd, and our tax code should treat it as such. If these CEOs are worth their astronomical salaries, these companies are more than welcome to cover the tax or to raise wages for their other employees. It's also time to institute a wealth tax so that we can deploy at least some of the hoarded and impossible to spend sums of money that the wealthiest have locked up, often built on the backs of workers, to programs that help give those same workers fair and decent life. It's time for the wealthy to stop viewing taxes as a punishment instead of a responsibility. A half century has been spent denigrating the government and all it can do to protect its vulnerable and poor. But good governance is possible, and it can't exist without revenues adequate to the challenges it has. The wealthy have begun to think that society and government should serve their interests alone. That's why I'm a proud class traitor. It's time for the rich to ask what we can do for our country, not the other way around. Thank you, Chairman Sanders and Ranking Member Graham and the committee.
Thank you very much, Ms. Disney. Our next panelist is Gabriel Zuckman, Associate Professor of Economics at the University of California in Berkeley. His research focuses on accumulation, distribution, and taxation of global wealth, and analyzes the macro distributional implications of globalization. Professor Zuckman, thanks very much for being with us.
Thank you, Chairman Sanders, Ranking Member Graham, and members of the committee for inviting me to testify today. My name is Gabriel Zuckman, and I'm a professor of economics at the University of California, Berkeley. The United States used to have one of the most progressive tax systems in the world. Let's take a look. From 1930 to 1980, the top marginal federal income tax rate averaged 78%. This top rate reached as much as 91% from 1951 to 1963. No other country, with the exception of the United Kingdom, ever applied such high marginal tax rates on the wealthy. Moreover, the US tax system was progressive not only on paper, but in actual facts. All taxes included, the average tax rate of the top 0.1% highest earners reached 50 to 60% in the 1950s and 1960s. Today, the situation is very different. When taking into account all taxes paid at all levels of government, the US tax system looks like a giant flat tax that becomes regressive at the very top end. Americans pay on average 28% of their income in taxes. This is the official tax to national income ratio of the United States. And all groups of the population pay more or less 28% of their income in taxes. The main exception is the 400 richest Americans, billionaires, who pay less than 25%, less than the middle class. So how is this possible? Working class Americans pay a significant fraction of their income in payroll and sales taxes. Billionaires, on the other hand, enjoy two major tax breaks. Number one, dividends and capital gains, the two key sources of income for billionaires, are subject to low statutory tax rates of 20%. Second, and more important, a lot of the income of billionaires is not subject to the personal income tax. Jeff Bezos, Elon Musk, Mark Zuckerberg, Larry Page, Sergey Brin, Warren Buffett, I just named 6 of the 10 wealthiest Americans. They are all large shareholders of companies that do not distribute dividends. Their true economic income is their share of their company's profit, but because their companies do not distribute dividends, most of their economic income is tax-free. The only sizable tax that billionaires pay is the corporate tax they pay through the companies they own. But now a key problem comes into view. The corporate tax has almost disappeared. In the early 1950s, the corporate income tax collected as much revenue as the individual income tax, in both cases about 6% of national income. Today, the corporate tax raises only about 1% of US national income. A large part of the decline owes to the rise of tax avoidance, in particular the shifting of profits to tax havens. More than half of the foreign profits of US companies are booked in tax havens today. In 2018, according to the most recent data, US multinationals booked more profits in Bermuda and Ireland than in the United Kingdom, Japan, France, Germany, and Mexico combined. So how to make the tax system more progressive? With a stronger corporate tax, a more progressive income tax, and also with a wealth tax. Why isn't the income tax enough? Because many billionaires have little taxable income, so that even increasing the top marginal income tax rate would not make a significant difference to the taxes they pay. The proper way to tax billionaires is with a wealth tax. And the wealth tax can work. In the US, property rights are well defined. Most assets have clear market values. And when market values are missing, they can be estimated. There's no technical obstacle to making the tax system more progressive. Tax avoidance and tax evasion are not laws of nature, they are policy choices. Before the creation of the federal income tax in 1913, income taxation was decried as impractical, dangerous, a fantasy imported by European professors. Today, the federal income tax is widely recognized as a large success. The wealth tax on billionaires could be a success too. I look forward to your questions. Thank you.
Thank you very much, Professor Zuckman. Our next panelist is in fact with us today in the room, and that is Amy Hanauer, who is the Executive Director of the Institute on Taxation and Economic Policy. She has 30 years of experience working to create economic policy that advances social justice and is the Executive Director of ITEP, works to promote fair and equitable state and national policy. Ms. Hanauer, thanks so much for being with us.
Thank you for having me, Chairman Sanders and Ranking Member Graham. Thank you for the opportunity to speak to this committee. My name's Amy Hanauer. I'm the Executive Director of the Institute on Taxation and Economic Policy. In 2020, the pandemic killed hundreds of thousands of Americans, and unemployment soared to levels not seen since we began collecting data in the 1940s. Despite that, Amazon's profits surged to $20 billion last year, but the company paid just 9.4% of its profits in federal corporate income taxes after paying 0 in 2018 and about 1% in 2019. Their total effective federal corporate income tax rate over 3 years was just 4.3% on $44.7 billion in profits. That's a far cry from the statutory rate of 21%. Netflix's 2020 profits surged to $2.8 billion because people went out less and watched more TV at home. Yet the company paid less than 1% of those profits in federal corporate income taxes after paying nothing in 2018 and about 1% in 2019. Over those 3 years, Netflix paid a total effective rate of just 0.4% on $5.3 billion in profits. Again, not at all close to the 21% statutory rate. And late last week, we learned that Zoom, the video conferencing platform that has become ubiquitous for meetings, saw its profits spike by a staggering 4,000% last year. But the company paid 0 in federal corporate income taxes for 2020. Zoom, Amazon, and Netflix are not alone. The pandemic has been hard on many businesses, large and small, and many reported losses last year, but some with profits, indeed, even some with record profits, still avoided paying corporate income tax. So far, my colleagues have found more than 50 S&P 500 corporations that reported profits but paid no federal corporate income tax last year, a year when our lives depended on public resources for testing, research, and vaccine distribution. Let me point out some truths about corporate tax avoidance. First, lawmakers could address this but have chosen not to. We knew about the corporate tax avoidance crisis long before Congress drafted a major tax overhaul signed into law by former President Trump in 2017. In fact, the figures I share with you today are the result of that law's first 3 years. Second, the tax avoidance is not due to the current economic crisis. The corporate income tax is a tax on corporate profits. It doesn't affect companies that aren't profiting. Closing special breaks and loopholes would not hurt businesses laid low by the pandemic. Third, the corporate tax dodging hurts ordinary Americans by reducing resources to pay for things we all need. Trump administration officials claimed their corporate breaks would boost the economy. In fact, GDP growth in the law's first 2 years was 2.9% and 2.2%, comparable to or well below 2015 levels. Proponents of the tax breaks also said benefits would be passed on to workers, claiming salaries would increase by $4,000 to $9,000 annually. This never happened, and the Congressional Research Service found that instead, $1 trillion went to share buybacks, which mostly enrich wealthy stockholders. This matters to the Senate Budget Committee because you will soon be asked to decide what our nation can afford to do to improve our economy and health going forward. Our research finds that corporations already have too many tax breaks, but some lawmakers want to preserve or even expand corporate tax cuts in the Trump law. As you know, the law includes a tax break, the expensing provision, that is set to expire. It also includes tax increases related to interest deductions and research expenses that have yet to take effect. Lawmakers call for extending the temporary break and repealing the upcoming increases, but both of those would be a mistake. Yet some of these same lawmakers also claim that we cannot afford to help people directly. They argue that we can't make permanent the child tax credit expansion that's projected to reduce child poverty by 45%, or that we can't invest in green jobs, or we can't invest in updating our failing infrastructure. I ask that instead of choosing corporate tax breaks, you choose to provide benefits directly to families in ways that clearly reduce poverty and improve lives. In my written testimony, I specify how we can stop corporate tax avoidance, including by passing some of the bills introduced by members of this committee. We look forward to working with you on making our tax code work for all of us. Thank you so much for the opportunity to testify.
Thank you very much. Our next witness is Maya McGinnis, President of the Committee for a Responsible Federal Budget. As a leading budget expert and a political independent, she has worked closely with members of both parties. Ms. McGinnis, welcome.
Thank you so much. Chairman Sanders, Ranking Member Graham, and members of the committee, thank you for inviting me here today. Let me start by saying that we've engaged in an unprecedented amount of borrowing in the past months, which is exactly what we should have been doing. This has been a terrible crisis, and while the most recent package was larger and less targeted than we thought was warranted, the overall COVID response has been very successful in fighting the pandemic, alleviating economic hardships, and fostering the recovery. The good news is that we seem to be coming out of the worst part. The bad news is we had a mountain of debt before the crisis, and we have a much larger mountain now. Going forward, we are on track to borrow $15 trillion over the next decade, assuming there's no new borrowing. And borrow have major insolvent trust funds, including both Social Security trust funds. This leaves people who depend on these programs vulnerable. It leaves our economy vulnerable to shifts in interest rates and foreign demand for our debt. And it leaves the nation vulnerable as the national debt is a national security threat as well. So I appreciate the topic of the hearing because revenues will have to be a significant part of the solution. The main point I'd like to make today is that they alone will not fix the imbalances we face or pay for the expansive agendas that are being discussed. So one of the tricky things about paying the fair share is, of course, that fair is in the eye of the beholder. I personally think that making the tax code and our spending programs more progressive is the right thing to do in light of trends in inequality, mobility, security, and opportunity. So here are some options to consider. Clearly, we need to do something about the very large tax gap and ensure that people pay what they actually owe. We should look to reduce tax expense. Year alone will lead to $1.8 trillion in lower revenues. And while some of these breaks are worthwhile, many are expensive, regressive, distortive, and we should make a number of changes. We should also consider changes to the estate tax and how we tax capital. On the corporate side, the rate reduction to 21% far exceeded what most think was necessary in terms of competitiveness, and we can bring up that rate, though I have always thought the more sensible approach is to tax more on the individual side rather than the corporate side because capital is so mobile. One thing we most certainly should not do is tax cuts further for the well. We should not do further tax cuts for the well-off. For example, by restoring the SALT deduction, which would provide an average of $40,000 in annual tax cuts for millionaires and billionaires. So I think that would be one of the most unwise tax policies we could be considering. How far will this get us? To stabilize the debt at today's level of 100% of GDP over the next decade, which is very high, it would take $4 trillion in savings. This could be done by enacting all of President Biden's proposed campaign agenda, tax increases, higher tax rates, limits on tax expenditures, expanding the minimum tax, et cetera. If you want to finance his spending agenda as well, probably $11 trillion in new initiatives, you'd have to go further from what is already a pretty aggressive set of tax increases, for example, by imposing wealth tax, transaction tax, boosting individual and corporate rates as high as 50% and 35% respectively, and this would still leave a $6 trillion hole. A more expansionary set of policies such as Medicare for all, free college, student debt cancellation would cost even more. And even if net revenues were able to be kept below 30 trillion, you'd need to impose either a 32% payroll tax, a 25% increase in all income tax rates, including raising the bottom rate to 35 and the top to 62, a 42% VAT, or doubling the individual and corporate income tax rates, or some combination. So the point is, we need to look at both sides of the ledger. Going forward, the growth in deficits is driven primarily by growth in health, retirement, and interest, which are responsible for 86% of the growth in spending over the next decade. Types of measures we could consider on that side: measures to control healthcare costs, for sure, that would have many benefits. Changes to save Social Security, which also can be used to make this program more progressive, same as the tax code. So we could start by means testing or changing the benefit formula. Other changes will need to be made to save Social Security, including lifting the payroll tax cap, broadening the base, increasing the retirement age, and/or fixing COLAs. Finally, we should reinstate reasonable discretionary spending caps at a level that we can actually stick to. So the fiscal hole is so deep that basically all credible options will need to be on the table, and the longer we wait, the longer this list will have to grow. Fiscal responsibility is not about big government or small government. It's about being willing to pay for the priorities you want to spend money on. Shifting costs to the future is at odds with the principle of serving as a good steward for the economy, the nation, or the next generation, even when that is money well spent. So thank you again for hosting this hearing today. It's so important that we focus on these important issues.
Thank you, Maya. Scott Hodge is next, president of the Tax Foundation. He is recognized as one of Washington's leading expert on tax policy, the federal budget, and government spending. Mr. Hodge.
Thank you, Ranking Member Graham, Chairman Sanders, and members of the committee. I appreciate the opportunity to speak with you today. Let me suggest that there is no objective standard for what defines fair share. It is a purely subjective concept. But there are facts which are objective, and the facts suggest that the U.S. tax and fiscal system is very progressive and very redistributive. Let's dive into some of those facts. We'll start with individual taxes and move on to corporate taxes. According to the latest IRS data for 2018, the year after the Tax Cuts and Jobs Act, the wealthy in America now bear the heaviest share of the income tax burden than in any time in recent history. The data shows that the top 1% of taxpayers pays 40% of all the income taxes. By contrast, the bottom 90% of taxpayers, about 130 million taxpayers, combined pay less than 30% of all income taxes. It's hard to say that the tax code is rigged in favor of the rich when more than 53 million low and middle income taxpayers, that's 1/3 of all taxpayers, have no income tax liability because of the numerous credits and deductions that have been created over the last few decades. Since the creation of the child tax credit in 1997, the percentage of income tax filers who have no income tax liability has increased from 23% to nearly 35%. The doubling of the child tax credit in the Tax Cuts and Jobs Act knocked more than 4 million taxpayers off the income tax rolls. Redistribution is also at record levels. According to a recent CBO report, the bottom 60% of households in America receive more in direct government benefits than they pay in all federal taxes. Meanwhile, the top 20% of households paid $1.7 trillion more in taxes than they received in direct government benefits. These figures demonstrate the results that one would expect from a highly progressive and tax and fiscal system. Now let's look at the corporate side of the tax ledger. Now, if the tax code was rigged in favor of corporations, we would have more of them. Today, there are about 1.6 million corporations, the fewest number in 50 years, and 1 million fewer corporations than there were in 1986. The likely reason for that decline is the fact that we have levied one of the highest corporate tax rates in the developed world for the past 30 years, and the fact that, of course, that corporate income is taxed twice, once at the entity level and again at the shareholder level. But because of the growth in pass-through businesses over the last few decades, more business income is taxed today on individual tax returns than on traditional corporate tax returns. That said, an OECD study found that the U.S. tax system is still one of the most business-dependent tax systems anywhere, as American businesses pay or remit 93% of all the taxes in America. More importantly, economic studies show that workers bear at least half of the economic burden of corporate taxes through lower wages, with women, low-skilled workers, and younger workers impacted the most. Another OECD study found that the corporate income tax is the most harmful tax for economic growth because capital is the most mobile factor in the economy. So raising the corporate tax rate would not only slow the economy, it would hurt marginal workers. The Tax Foundation's General Equilibrium tax model determined that raising the corporate tax rate to 28% would reduce long-run GDP by nearly 1% and eliminate nearly 160,000 jobs. Over the long term, we found that the model shows that middle and low-income taxpayers would see their incomes fall by 1.5%. Raising the corporate tax rate to 28% would once again give the United States the distinction of having the highest corporate tax rate in the industrialized world after factoring in our state rates. This is no time to do that when France and Sweden and other countries are cutting their corporate tax rates to attract more investments and jobs. In fact, China's corporate tax rate is 25%, and we don't want to lose ground against our biggest economic competitor either. Now, let me conclude by saying the best way to address inequality in America is through permanent tax policies that promote increased productivity, more jobs, higher real wages, and real economic growth. That's the kind of inclusive growth that all of us should be able to support. Thank you for your time and attention. I would appreciate any comments or questions that you may have. Thank you, Mr. Chairman.
Thank you very much, Mr. Hodge. And again, I'm going to apologize. There are a number of votes taking place on the floor, so you're going to see people disappearing for a while. Let's start the questions off with Professor Zuckman. Professor Zuckman, how does it happen that the top 1% in the United States are able to underreport about 21% of their true income? What is that? How do they do that? And what does that mean for tax revenue in our country?
Thank you very much, Senator, for your question. Indeed, according to a recent study that was published earlier this week, the top 1% underreports about 20% of its true income. By contrast, the bottom 50% of taxpayers underreport about 7% of their true income. So income underreporting appears to rise quite significantly with income. And that's due to a number of reasons, but one reason I want to emphasize is the dramatic budget cuts that have happened for the IRS over the last decade that severely limit the ability of the IRS to audit high-income taxpayers extensively. And I think it is critically important, and in fact, this should be the number one step towards a fairer tax system, to increase the IRS budget for enforcement. This is essential to improve the actual progressivity of the tax system. And let me mention two areas where enforcement could be improved, and two reasons why there's a significant tax gap at the top. One is that there is substantial evasion in complex business structures, including partnerships. And second, there is continued offshore tax evasion, the concealment of assets and income in offshore tax havens. These are two areas where there is a need for much stronger enforcement.
Professor, thank you very, very much. Let me go to Ms. Hanauer. Ms. Hanauer, in 2018, Amazon, one of the most profitable corporations in the world, paid nothing in federal income taxes. Now, people are shocked to hear that. How does that happen, that a hugely profitable corporation owned by the wealthiest guy in the world pay nothing in federal income tax?
Yeah, thank you so much for that question, Senator. I mean, I think that there are three primary ways that you see very profitable corporations avoiding income tax. One is the offshore corporate tax avoidance that Professor Zuckman talked about. And we could address that by equalizing rates on domestic and foreign profits, or coming as close as possible to doing so. I know you've had a bill to address that, and I think that that's a very good direction to go in. A second is in a more domestic way, which is that a lot of companies use accelerated depreciation or even expensing to avoid taxes on their assets, and we would favor instead having economic depreciation on those assets. And again, I think that that's something that you have proposed. And another way that we see a lot of domestic tax avoidance is having this stock options book tax gap, where when companies pay out compensation in stock options, they report one thing to the IRS and they report something entirely different to their investors. That does not make a lot of sense. So we agree with Professor Zuckman that better funding the IRS is part of the solution, but so is addressing these three major forms of avoidance.
Okay, thank you very much. Let me direct a question to Ms. Disney. Your father and uncle created, one of the great iconic corporations in the world. Did the high tax rates of the 1950s and 1960s cause your family to work less hard and be less innovative?
Thank you, Senator Sanders. I would offer that the proof for that is probably in the pudding. We know that the 50s and the 60s were some of the most creative, successful years at the Walt Disney Company. They were never entirely working for the money. And so what the tax environment was really didn't have an impact on how they went about their business. But over and above that, it's really important to remember that so much of what they did couldn't have been done without massive spending, for instance, on the highway bill in the 1950s. Without the highway bill, you get no Disneyland, no Disney World. So in fact, they benefited by the high tax environment because of the massive federal and state investments in infrastructure.
Good. Thank you very much. Senator Graham?
Mr. Hodge, for about 30 seconds, would you like to comment on the Amazon situation?
Senator, I've never looked at Amazon's tax returns or their books. what I can say is that when companies pay very low taxes, generally what they've done is followed the rules that Congress has provided in the tax system. So in order to take things like accelerated depreciation or bonus expensing, they have to do the right thing. They have to buy new trucks, new equipment for their factories, new tools for their workers. That all increases GDP and economic growth, so that's a good thing. They also provide stock options for their employees, which makes their employees wealthier. So they're sharing the wealth of the company with their employees. All of those are in the tax code, and so they're doing the right thing, and that's all things that Congress has put in the tax code for companies to do.
Okay, let's see if we can get a baseline of understanding about what all these numbers are accurate or not. You say that 1%, the top 1% of the wealthiest people in the country pay 46% of income taxes, is that right?
40% of
40%.
income taxes,
Okay.
yes.
Mr. Zuckman, is that right? Zuckman. Professor?
Yes, yes, Senator, this is correct, I believe.
Okay, that's correct. All right, that's good. Is it true that about 30% plus of Americans pay no income tax?
35% of all Americans who file an income tax return pay zero income taxes because of largely tax credits such as the child tax credit, earned income tax credit, education tax credits, and so forth.
That's federal income tax, correct?
Federal income tax, that's correct.
Yeah.
And according to CBO data, many of those are refundable tax credits, which actually completely offset their payroll taxes as well. Actually, according to CBO data, the bottom two quintiles have negative effective tax rates because of the generosity of those refundable tax credits.
Professor, do you agree with that statement?
Senator, I think when studying the progressivity of the tax system, it's important to take into account all taxes at all levels of government. And when you do that,
I just asked you a question. Do you agree with what he said?
yeah, I agree with this.
Now, I understand where you're coming from. But just trying to get some data points here. What is the average corporate tax rate in the industrialized world, Mr. Hodge?
It's a little over 25% if you adjust it for economy size. The U.S. Corporate tax rate right now, when you add the federal rate of 21% plus the state rate, is about average in the industrialized world right now.
And the proposal to go to 35%, how does that affect our ability to create jobs in our economy here at home?
That would instantly make the U.S. Having the highest overall corporate tax rate at around 32%, which would be much higher than even France right now, which is moving to 25%. Sweden is reducing their rate to around 20% as well. That's the trend among global countries to make themselves more attractive for investment and jobs.
So, Ms. McGinnis, are you with us? Ms. McGinnis?
I am with you.
Okay. So if you took the entire wealth of the top 1%, their houses, their dogs, everything they own, how much money would that be for the federal government?
I'm sorry, Senator, I don't know the answer to that offhand. Hoping one of our other panelists does.
I think it's about $30 trillion. I can't remember, but it's a fraction of what you would need to get us out of debt is my question. Do you agree with that? If you confiscated all the wealth of the top 1%, that doesn't get the nation out of debt. Is that a fair statement?
Yeah, I think you couldn't possibly confiscate all the wealth and it wouldn't be able to get us out of debt on the debt trajectory that we're on. That's correct.
Okay. And for us to get out of debt, we're going to have to adjust entitlement spending and maybe revenue generation too. Is that correct?
Yeah, and I want to be sort of realistic. I don't think we're going to be able to get out of debt. I don't think we need to get completely out of debt. At this point, I would,
right, a better ratio.
Just to get us to the point where the economy is growing faster than the debt instead of the reverse. And we are not going to be able to do that along with this expansive agenda without looking at all parts of the budget. So taxes on the well-off, but also probably broad-based taxes if we're talking about big expansions, and certainly changes on the spending side.
Yeah, and the spending side is really driven by entitlements. Is that correct, mostly?
That is correct. Healthcare and retirement, and growth on interest as well.
So if you Social Security and Medicare have to be dealt with or they're going to run into a major shortfall. Is that correct?
And I think it's such an important point because by not having dealt with them over the past years, we have ignored the reality that we're an aging population, that every year we wait to deal with them, the costs become greater and fall more on the people who depend on them. And many of the things that could have helped to shore up those programs before are now not going to be enough. And so it's really dangerous how long we've waited, and we shouldn't wait any longer. You are going to need to make changes so that we don't have across-the-board benefit cuts.
Thank you very much. Sorry, Mr. Chairman. Went over.
Thank you, Senator Graham. Senator Van Hollen will join us via video.
Thank you, Mr. Chairman. I want to thank all of our witnesses here today. Ms. Hanauer, I think Mr. Hodge just acknowledged in response to Senator Graham's question that the figure he cited about 1%, the top 1% paying 20%, having 20% of income, but paying 40% of taxes did not include state and local government taxes. I think it doesn't include payroll taxes either. I know that your organization has looked at this. Can you tell us when you factor those in what the numbers are?
Yes, thank you so much. And I think that that's a very important point. We need to look at payroll taxes, state and local taxes, and sales taxes, and all of the taxes that people pay when looking at the progressivity of our tax code. And when we look at all of those things combined, we find that the tax code is very, very slightly progressive when we don't consider wealth. And so we are hardly in a position where we are taxing the rich. In fact, quite to the contrary, as Ms. Disney so eloquently pointed out, it is the wealthy who gain the most from our systems and our society, and we need to make sure that we can pay for all of the things that help to grow wealth in this country.
Thank you. Now, I want to talk a minute about stepped-up basis because I'm going to be introducing legislation in the coming days to deal with the issue of stepped-up basis and how very wealthy families can pass that wealth on from one generation to another without facing any taxes. Could you, Mr. Zuckman, talk briefly to the importance of addressing this issue of stepped-up basis and what the consequences of allowing that loophole to continue would be?
I think this is indeed very important. Stepped-up basis is a major loophole in the federal tax code, and closing it would not only directly improve the progressivity of the tax system, but more importantly, it would make it much easier to increase the tax rate on capital gains. Because right now, high-income individuals can defer capital gains realization and benefit from this loophole stepped-up basis at death. By closing this loophole, it would become much simpler to increase capital gains taxation. So this is extremely important.
Thank you. And Ms. McGinnis, first, thank you for mentioning the tax gap. The fact that the IRS has not received adequate funding has not only resulted in lack of good service to taxpayers, but also a large annual tax gap. And we know that about 70% of those unpaid taxes are from the very wealthy. So that would be a first important start. But I know you mentioned in your testimony the issue of looking at taxes on capital, individual capital. And what are your views on addressing the stepped-up basis problem?
Yeah, no, I think looking at step-up basis is a perfectly appropriate and smart policy. We can debate what the appropriate tax rate would be for capital gains, but there shouldn't be a huge loophole where people pay zero. And so improving this would be a way to raise revenues and make the tax code fair and more efficient. And it was in the past that we didn't have the administrative ability to do this so well, but I believe that now we do.
Thank you. And Ms. Disney, thank you for your testimony, your active participation in all these issues and trying to have a more fair and equitable society. Can you talk about how families have been able to use the stepped-up basis loophole over time?
I'm sort of, thank you, Senator. I'm a little bit of a poster child for the benefits of the stepped up basis because my basis in Disney stock is pretty nearly zero. And I can imagine this for someone like Jeff Bezos being an incredible boon to his capacity to pass wealth on untaxed to his children. Because if I were to pass my shares off onto my children with a basis of almost zero, and now at however many multiples of 190, whatever it is right now, that would be just offering them all that wealth appreciation with no tax at any time on its growth. So it does seem to me to be a rather big giveaway.
Well, I appreciate that, Ms. Hanauer. I know we don't have much time left. Do you have a view on this very quickly?
Yeah, absolutely. I think that this is absolutely the right way to go. It enables dynastic wealth to be passed on, and we have families in this country that can't afford childcare for their children. It would make much more sense to pass on our collective wealth in ways that enable every family to afford those necessities.
Well, we have a draft piece of legislation that is almost finalized. As I said, we intend to introduce it shortly. I'd like to circulate it to all the witnesses here for your comments in the coming days. Thank you, Mr. Chairman.
Thank you very much, Senator Van Hollen. Senator Kane, I believe, I don't know that we have any Republicans on the line, so Senator Kane, your timing is perfect.
Thank you, Mr. Chair. I wish my timing were always as good as it just was, and I thank you for calling the hearing. I think this is a very important one. And to the witnesses, you probably noticed we've been alternating between votes and other committee hearings, but glad to have you with us. And I think there's a lot of big ideas about tax reform that are out there. I think Senator Wyden has an idea about tax reform. Senator Cardin has, I think, often introduced a comprehensive tax reform bill that would look at a consumption tax. Senator Johnson, and I don't know if he's been here today, has ideas about tax reform. I hope we might get into a big kind of theory of, or structural tax reform discussion. My worry about 2017, not only did I oppose the bill, but it wasn't really tax reform. I just viewed it as a set of tax cuts benefiting people at the top. And I'm a little bit nervous. I think we'll probably get a proposal from the White House dealing with taxes potentially as a pay-for an infrastructure plan, and they might all be individual items that I approve, but I'm not really sure it's going to be tax reform. I think it's just going to be a readjustment back from what we did in 2017, and I'd love to have a significant discussion about tax reform. Woody Guthrie has this great line in a song called "I ain't got a home in this world anymore. The gambling man is rich and the working man is poor." And if you look at our tax code, I've always sort of felt that way about it, that if you gave it to a Martian and said, "Tell us what it says about us," the Martian would say, "You know, I've looked at that tax code and it says that you like investment a lot more than you like work because the tax rates applied to wages and salary are higher than they are applied to many forms of investment income, carried interest, capital gains, and others." I really like investment, but I like work every bit as much. And I just don't like the fact that we have a tax code that does not tax earnings at the same level as wages and salary, investment earnings, because it skews the way we structure transactions, skews the way people choose to get paid, but it also has a significant disadvantageous and inequitable effect on lower income people because they don't have the ability necessarily to get paid in ways that get the lower tax rate applied. So really my one question to y'all is why not have a tax code that basically kind of treats income as income and applies the same tax rates to all kinds of income, capital gains, interest, dividends, carried interest, wages, and salaries? Wouldn't that be a better way to both simplify and make a tax code that's more equitable?
Yeah,
Should we
thank
just jump in?
Please.
I'll jump in, Senator. Oh, sorry, go ahead.
So we'll go Amy and Maya and then Scott. And I don't know, there might be a fourth person too, but that's
Great.
my only question.
Thank you so much. I really appreciate that question, and I think you're absolutely right. The disparity in the way that we tax earnings from work as opposed to earnings from wealth doesn't make any sense because, people who get up every day and work hard deserve to have those earnings treated as favorably as somebody who simply watches their investment portfolio grow. And I think it leads to great economic divides in this country. It leads to wealth that gets passed on from generation to generation. It also leads to deep racial divides because we know that Black and Latino families have not had the same opportunity to build wealth in housing and in stocks in the same way that white families have as a whole. So what we really need to do is to restore that equity as you're describing, and I appreciate your interest in that issue.
How about Tamaya and then Scott? I think Scott wanted to say a word.
Yeah, thank you, Senator. I was nodding through the whole question because I think it used to be so important that we incentivized saving and investment more so than it is today, and we really need to focus on incentivizing work. I think that's true both in the tax code and also on the spending side of the budget. What I really wanted to add is your point about comprehensive tax reform is so critical because our entire economy is changing massively, whether it's still ongoing issues in globalization, technology, the future of work. We have so many tax breaks that make no sense. We have to clean this up and do a big overhaul, keeping in mind issues of competitiveness, economic growth, changes in technology, and income inequality. So I really welcome that approach.
Mr. Hodge.
Yeah, Senator, what you've described is the Estonian tax system, which has on the corporate side a distributed profits tax. So it's not taxed when it's kept within the company, but only taxed when it's distributed to shareholders. They have a flat income tax rate of 20% and then a flat corporate rate of 20%. And so you basically tax the same income only once, and there's no level of double taxation like what we have in our system.
I like that idea. I would still have progressive rates, but I do like applying the same rate to income wherever it comes from.
Yeah, Australia does that, and they have
Okay.
what their imputation system has a progressive system, but it applies a credit for the corporate taxes paid to individual shareholders, so it equalizes that. So quite a good system.
Great. Thank you, Mr. Hodge. Thank you.
I'd love if I could, Senator, if I could, I'm sorry. I'd love if I
Mr.
could
Chair,
just
could
jump
you-
in on this.
Please.
Oh, thank you. I just wanted to say, as a beneficiary of the favorable capital gains tax rate and the way that just in general we privilege ownership over work, I get the same amount of money at the end of every day, whether I've been sitting on my tuchus filing my fingernails or whether I've actually been a contributing member of society. And I think it's really important to remember that tax code is as much a message as anything else. And what the message that we're sending right now with our tax code only reinforces the idea people have of themselves at the very high end of society, that they're somehow better, more worthy, more valuable to society. When, as we know, it's quite the opposite. The people we need most of all and called for a year now essential are the people who do the work every day.
Ms. Disney, thank you. Mr. Chair, I just want to say my grandfather, Leo Michael Burns, grew up with your grandfather, Walt Disney, in Marceline, Missouri.
Fabulous.
Senator Johnson.
Thank you, Mr. Chairman. I couldn't be more pleased to be following the comments from Senator Kaine. There's an awful lot of area of agreement. I think I mentioned at our wealth disparity hearing that income ought to be taxed as income. Income's income. And as a result, I don't think there's any secret. I was not a real fan of the 2017 tax reform. I, in the end, voted for it because I think we needed a more competitive tax system, and I don't think we were. I don't necessarily agree with Ms. McGinnis when she said that we overshot the corporate rate. But during that time frame, I was talking to people like Senator King and Senator Kaine, as well as a lot of economists on all sides of the political spectrum, about what I called the true Warren Buffett tax. Close to 95% of American businesses have their business income taxed at the ownership level. I think, Maya, you were talking about the fact that it's best to tax individuals. So what I was proposing is make all business income taxable at the individual level. Turn C Corps into pass-throughs. Actually talked to Mr. Buffett about this because I was going to call it the true Warren Buffett tax. He was intrigued by it. I'm not saying he supported it, but he was intrigued enough to put me in touch with his shareholder services company to iron out the details. We had about a, I don't know, hour-long meeting with 3 experts from Joint Committee on Taxation. I think at the end of that meeting, I think everybody decided that, yeah, this is a change, but what those shareholder services companies have to do for companies and shareholders is far more complex than what I was contemplating. So this is doable. And the advantage of it, and let me just quick lay out, and Mr. Hodge, you obviously were working on this, you helped me score it. I'd like you to try and score this again. But in the simple way of talking about this is, let's say a little old lady in Oshkosh, Wisconsin owns a share of stock, and $100 of income is attributed to that share. So she's going to get something like a W-2, says you have to report $100 of income, but the corporation has already deposited, like payroll withholding, $25 on your behalf. Now, the benefit here is the taxes have already been paid. Again, Mr. Hodge, you were saying 93% of taxes are collected from corporations. So we've got the tax collected, but that little old lady, if she's only got a 10% tax rate, she'll be able to claim a 15% refund. Now, Warren Buffett, he'll have to pay more taxes, which means there'll be a little bit more pressure for corporations to divest themselves of all this pent-up capital. They'll have to pay more dividends for a more efficient allocation of capital. This would incentivize low-income earners to become shareholders. Again, it will force corporations not to pay tax. The individuals are paying tax, but to distribute income for a more efficient allocation. Now, if there's all kinds of things for that corporation to invest, they can sell more stock, and they'll be able to get capital. They can also borrow money. So, Mr. Hodge, I know we spoke about this. First of all, let me ask you, are you willing to do another round? I think I've got some people interested in this. I just met with my White House liaison, gave her all the information as well. They were going to have further discussions. I mean, can we count on the Tax Foundation to look at this and potentially score it?
Absolutely. We'd be delighted to work with your team on it. I think moving toward what you might call an integrated system for corporate taxation is the right approach. Removes that double layer of taxes and then provides some equity there, as you suggest, with a more progressive rate on the individual side.
And by the way, a very small percentage of C corporation income is ever double taxed. So much of it is owned by nonprofits, foundations, pensions, that type of thing. So it's, the double taxation dividends just doesn't happen all that much. So again, there's a lot of income that we never tax. And quite honestly, some of this massive wealth has been accumulated because of the C Corp status, because you never pay dividends, the stock price just increases, and it's never really subjected to tax ever. So this also would eliminate that tax avoidance problem. Ms. Hanauer, your organization also does scoring, correct?
I don't know that we exactly do scoring, but we do analysis of the tax code.
Okay, well, I'd love you to take a look at this as well if you're interested. I'd love to meet with you if this...
We'd absolutely love that. And I just should say, I lived many happy years in Wisconsin, had my first child there, so it's nice to meet you.
Why'd you leave?
For a job.
Okay, that's a good answer. Maya, do you want to just weigh in on this a little bit?
I would just say I've been a supporter of this approach forever. I've read many of the old corporate integration approaches. There's clear problems about making sure people don't, find different loopholes. But yes, this is what we should be shooting for. And Senator, I'm always pleased when you're working on big, bold ideas and excited to hear you're doing this.
Well, thank you all, and thank you, Mr. Chairman.
Thank you, Senator Johnson. Senator Lujan.
Thank you very much, Mr. Chair. Appreciate you calling this important hearing, and also Ranking Member Graham. When I talk to my constituents, many are struggling to keep a roof over their head, food on the table, and their businesses open. As President Biden has said, America is facing a national emergency that requires an aggressive response from Congress. The American Rescue Plan that I voted for puts Americans on the right path to recovery. Under the American Rescue Plan, families in New Mexico with 2 married adults and 2 children receive $5,600. It's a one-time payment in helping New Mexico families who struggle to get a car to safely look for work, to pay for rent, or even to get food on the table for their children. However, as you know, some of my Republican colleagues have suggested that we can't afford to provide meaningful assistance to struggling families. Ms. McGinnis, in my short time that I have, and if there's anything you want to submit to the record, I'd invite you to do so, but I'm looking for some numbers here. I have a few questions for you. Do you know how much the Republican tax bill of 2017 provides in tax cuts to a person making $200,000 this year in 2021?
Okay, I'm going to make sure we submit all the proper answer, but I think it would be roughly $5,000 this year.
So the number that I have is on average $6,500. So I'd be happy to chat with you about that, and we'll look
That's
into that.
if you include the corporate tax incidents as well, I think.
Appreciate that.
That makes sense.
Ms. McGinnis, do you know how much these tax cuts help those making $1 million? How much will they receive from the Republican tax bill?
And if you're counting that corporate part as well, probably in the neighborhood of $50,000.
That's what I have, about 51,000. Is that a one-time payment or is it annual?
That would be every year, in the past years, every year, and going forward until these tax cuts expire.
So every year, someone making $1 million gets about $51,000 from that tax cut in 2017. Okay.
But just also for the record, if we did SALT, a lot of them would be getting another $40,000 tax cut as well.
Okay, Mr. Zuckman, what is the average tax rate for the median taxpayer in the United States?
It's about 28% today.
And Mr. Zuckman, which income group has the lowest tax rate in the United States?
According to our estimates, it's billionaires, the top 400 richest Americans, who have the lowest effective tax rate today in the US.
So the top 400 richest people in America have a tax rate of 24%, and the average tax rate for the median taxpayer, that's middle income families, is 28%. It's 4% higher?
Correct.
Is that current tax system progressive or regressive?
It's a tax system that is not progressive, that's mildly progressive up to the very, very rich, and then becomes deeply regressive at the very top end.
Can you just help middle income families back in New Mexico understand this a little bit more?
Yes, absolutely, Senator. So what's really important to understand is that all Americans pay a lot in taxes, including working class Americans. They pay payroll taxes, they pay sales taxes. Very wealthy Americans pay the income tax, but for billionaires, the income tax is only a very small fraction of their true economic income. Or to put it differently, it's just very small compared to the profits of the companies they own and compared to their wealth. And that's why, at the end of the day, you end up in a situation where billionaires as a group have a lower effective tax rate than the middle class.
I appreciate that response. Mr. Chairman, what it seems to me is that the richest amongst us, and I congratulate them for their wealth, they've done well for themselves. But when the richest amongst us in America pay the lowest rates, the richest amongst us have over $50,000 more every year from the 2017 tax bill. The Republicans' tax plan cost Americans $1.8 trillion and largely benefited the largest corporations and the wealthiest 1% of Americans. However, our colleagues from the other side of the aisle now insist that the United States cannot afford to provide a meaningful relief to these middle-class families, including in New Mexico. It just seems wrong to me. 24, 28, those numbers just don't add up. And I'm hopeful that we can all work together to provide relief to families back home that I represent. Thank you, and I yield back.
Senator Lujan, thanks very much. Senator Toomey.
Yeah, I would just point out to my colleague from New Mexico that he might want to take a look at the approximately $4 trillion that Republicans voted for over the course of last year, the large majority of which were direct payments in one form or another to low and middle income people. To suggest that Republicans are unwilling to do anything is to simply choose to ignore the very recent history. I could carry on about the best economy of any of our lifetimes, which occurred just before the pandemic hit and included a narrowing of the income gap, a narrowing of the wealth gap, accelerating wages, full employment, more job openings than there were people looking for work. And maybe some people would suggest that that's all a big coincidence, that that happened right after we did a profound tax reform that made our tax code much more competitive. But I don't think that was the case. I think it was related very much to making, and I would suggest that our Democratic colleagues might think about wanting to go back to the best economy of our lifetime, want to go back to accelerating wage gains for low-income workers, because that's what I'd like to do. I'd like to get back to the most successful economy we had in my lifetime, and it was very much partly a result of the tax reform we did. I also want to correct the wild mischaracterization that we don't have a progressive tax code. In 2018, if you look at the share of who paid federal income taxes, for starters, the top 1% of income earners earned about 21% of all the income, 21%. They paid 40% of all the taxes. Well, gee, hard to say that people aren't paying their fair share, but look at the bottom 50%. The bottom 50% paid 2.9%. So the top 1% paid 40% of all taxes, income taxes collected. The bottom 50% paid 2.9. If you include all federal taxes and transfer payments through the tax code, the top 1% in 2018 paid about 30%. The bottom 50% of taxpayers have a negative effective tax rate because they get more back from the tax code than they pay in. Those are just the facts. Now, you could decide that you want to make sure to punish successful and productive people more and more, and you can make that value judgment. But please, let's at least be honest about this. I mean, Mr. Hodge, do you think it's fair to say the U.S. tax code is not progressive?
It's exceptionally progressive, Senator. And as I outlined in my testimony, there's a great deal of redistribution that goes on through both tax and spending policy. And then what CBO data shows is that between taxes and redistribution, the top 20% are seeing $1.7 trillion worth of their income being transferred from them to other households.
I appreciate that. I'm going to run out of time. So just a very quick question. In your studies, is the American tax code actually even more progressive than many of the OECD countries, for instance?
Yeah, an OECD study found that the U.S. income tax code is one of the most progressive tax systems in the industrial.
So we're being told that we don't have a progressive tax code when, in fact, we have the most progressive tax code. That's amazing. Let me talk. Now, here's one of the other ironies. It's our Democratic colleagues that are pushing for a provision that is absolutely, factually regressive, and that's the repeal of the SALT cap. Now, as you recall, SALT is the acronym for state and local taxes. And while I would have preferred that we not allow any deduction for state and local taxes, the compromise we had to settle for was a $10,000 limit. Now, our Democratic colleagues want a bigger limit or no limit at all. And what the ability to deduct state and local taxes does is it simply transfers the tax burden to lower income people who don't have large state and local taxes to pay, and it takes it away from wealthy people who do. So, if you live on the Upper East Side of Manhattan and you've got a multi-million-dollar home, you've got a lot of state and local taxes. And if you can deduct all that, that means that the middle-income family in Dauphin County, Pennsylvania, has to pay that much more. Let me ask Ms. McGinnis, am I getting this wrong, or do you agree that increasing the SALT deduction would be regressive?
Senator, you are so right on that. Getting rid of the SALT cap is really one of the more regressive tax cuts we could think about. I don't know why it's on the table. It would leave huge annual tax cuts for millionaires and billionaires. And the tax code, like you said, it is progressive. It's okay to want a more progressive tax code, but you shouldn't do that while pushing for regressive tax cuts or opposing progressive changes on the spending side, I would add.
Yeah, and if your argument is that we need to take the world's most progressive, or one of the world's most progressive tax codes and make it still more progressive, okay, we can have that discussion. But please, let's not suggest that we don't have a progressive tax code. I mean, that's just patently ridiculous. I would also, again, stress, there's actually a lot to be said for having an economy where there are more job openings than there are people looking for work, where the income differential is narrowing, where it's narrowing at an accelerating pace. I mean, I have yet to hear someone tell me what's wrong with the direction we were heading in. We had a hearing in this committee a few days ago where the data set that was presented to us was cherry picked to create a misleading impression that the income differential was widening, when in fact for 10 years now it's been narrowing. All I'm saying is I think that's a good thing. And I'd like to get back to a booming economy where people are experiencing that accelerated earning and narrowing the income and wealth gap. Ms. McGann, it looked like you were going to say something.
Well, I was, but you're not going to love my answer because I take that differently. As you know, we have disagreed on the tax cuts, but I think a lot of that growth, which was tremendous, and particularly what it was doing to the wage gap, was driven by the demand side and the huge deficits and kind of the short-term stimulus, which can't be sustained over the long term. So if you're debt financing everything, and we borrowed $4.7 trillion in taxes and spending increases during that period, huge burst for the economy, but not sustainable and damaging in the longer term would be the point I would make.
Well, you're right. We disagree about that.
We disagree, I know.
Okay,
Thank you for your indulgence, Mr. Chairman. I ran over.
okay. Thank you, Senator Toomey. Senator Warner.
Well, thank you, Mr. Chairman. And let me just say that I have great respect for my friend, Senator Toomey. But I got to tell you, in the last presentation, there was some cherry picking going on. And let me agree with him that on the SALT tax, I agree with he and my good friend Maya McGinnis. But the notional idea that somehow we have this progressive tax system in our country, when you look at income tax, you're right. Many Americans don't make enough to afford income tax. But when you look at the overall tax burden that low and moderate Americans pay, when you add in sales tax, when you add in FICA, when you add in Medicare, when you add in gas tax, when you add in the host of other taxes and fees, there is no doubt at all that our tax system does not rank as a system on the more progressive side. And the level of transfer payments now, I candidly probably a little bit agree with Senator Toomey. I don't want our transfer system to kind of duplicate the full European system. But I think, let's not cherry pick our numbers here when we're going to have this kind of overall discussion about tax code and fairness. And I do want to go to my friend, McGinnis, which again, I agree, we have spent close to $5 trillion in the last year, borrowed money. I think in the long run, history will say it was appropriate to recover both from COVID and get the economy reworking. But that was exacerbated by the fact that we had spent $2 trillion of additional borrowed money on a tax cut that disproportionately did benefit people like me and businesses at the top. And as a matter of fact, we now have a corporate tax rate of, the equivalent of 1.1% of our GDP in 2019. That is the lowest of any in the G7. And I've been pressing my staff on this because I thought they were saying it's also 33rd out of 35 on OECD. I actually thought that was our overall tax revenue rate, not our corporate tax rate, since many other countries have a nominally lower corporate tax rate, but they then have a VAT to make up for it. But now they've said, even at the corporate rate, we're 33 out of 35 in OECD nations. So, Ms. McGinnis, how are we ever going to be sustainable with these corporate rates and revenue coming out of industry at this size that is so small compared to all of our competitors? And how is that ever sustainable? At what point? Now, again, we have thought that point was going to happen sooner than it has, that this doesn't just blow up in our face.
Yes, thank you for the question, Senator. And I agree with you on so many of those things. We did think that the last recovery bill was more than it needed to be and not as well targeted. But overall, we did such an important job of being able to borrow to help with this. And thankfully, we were able to borrow, despite the fact that in the 3 years when the economy was strong prior to then, we borrowed $4.7 trillion, $2 trillion from tax cuts, but also another $2 trillion from spending cuts and another $500 billion in tax cuts. It was a free for all. And this has led our debt situation to be unsustainable and leaving us in a vulnerable situation where if interest rates go up by 1 percentage point, the interest payments we have will go up. They're already $300 billion a year, $2,400 per family. They'll go up by another $250 billion per year. One interest percentage point. So we are going to have to get on top of this fiscal situation. And we also, frankly, are underinvesting. So there are going to have to be new initiatives, and we're going to have to reform our social contract. But I don't think we should overpromise how we can do this just on taxes for the very rich. I think it makes sense to start there. I think we do have to look at the corporate tax rate, which at 21% is too low, though I don't think it should go back to where it was before. But we're also going to have to look at the spending side of the budget. Fixing Social Security is a must. And we'll probably have to do broad-based taxes. So I feel like the more things we're talking about, honestly, the closer we will be to ending the vulnerabilities we have from this unstable fiscal situation and this weak fiscal balance sheet.
Well, I agree with you. I also think, when we have a federal spend rate before COVID that had R&D, infrastructure, and any kind of training programs as less than 10% of our federal spend, that is a bad business plan that I would never invest in. I know my time is out, Mr. Chairman, but I will submit for the record a question, Mr. Zuckman, about the fact that whatever intentions that came out of the so-called tax reform of 2017, the guilty and fitty terms that most Americans don't recognize, unfortunately resulted, particularly in terms of R&D and intangible assets, in actually companies moving more of their operations offshore, not back to America. Senator Brown, Senator Wyden, and I are working on proposals to try to correct that, and appreciate the opportunity to have this issue brought to our forefront, Mr. Chairman.
Thank you. While Senator Sanders is off to vote, I'll continue this hearing and begin with my statement. While millions of working families in California and across the nation are struggling to keep up with their bills, stay in their homes, and put food on the tables after decades of stagnant wages and the devastating impact of the current economic crisis due to the pandemic, the federal tax code clearly works well for the wealthy and for large corporations. Just looking at the last couple of decades, under Republican administrations, Congress has passed tax cuts that have largely benefited top earners and business interests. The 2017 Republican tax law alone was particularly regressive, providing more than $1 trillion in tax breaks to corporations and the top 1% of earners. This law has allowed billionaires to pay effectively lower effective tax rates than many working families. It is also, and this is equally important, it has failed to deliver on the promises of a business investment boom even before the pandemic. By contrast, President Biden and congressional Democrats passed the American Rescue Plan, which is delivering critical tax relief to working families by delivering direct payments, improving the earned income tax credit, and enhancing the child tax credit that will cut child poverty in half this year. As we continue our work to defeat COVID-19 and reopen our economy safely, pursuing a progressive tax agenda is critical to building a more equitable and prosperous future for all Americans. Now, I do have an area of questioning for Professor Zuckman and Ms. McGinnis relative to the IRS. Following nearly a decade of funding cuts, the Internal Revenue Service's capacity to enforce our tax laws, particularly for the wealthiest corporation and the wealthiest families who tend to have more complex filings, has been severely diminished. In the past 10 years, the agency has been forced to eliminate 22% of its staff, and funding for enforcement activities has dropped by about 30%. These cuts have primarily benefited the wealthiest households and corporations that fail to pay their taxes in full. A 2019 study found that 70% of owed but unpaid taxes equaling $267 billion is explained by the underpayment by the top 1%. Since 2012, the number of tax returns filed by millionaires that were audited fell by 72%. During that same period, the share of companies with more than $20 billion in assets that were audited fell 59%. Investing in the IRS would not only support fairness and the integrity of the tax code, but it would also help reduce the deficit. The Congressional Budget Office estimates that increasing IRS funding by $20 billion over the next 10 years would actually reduce the deficit by $40 billion due to the collection of additional unpaid taxes. So Professor Zuckman and then Ms. McGinnis, can you explain how increasing funding to the IRS is critical to instituting a fairer tax system?
Absolutely, Senator. I fully agree with what you said. I think that there is an urgent need to increase audit rates and fund more thorough audits for high income and high wealth taxpayers. The data that we have today suggests that the top 1% highest earners in the US underreport about 20% of their income. So that closing tax evasion just for that group, collecting all the taxes evaded by the top 1% alone would raise more than $170 billion annually each year in extra federal income tax revenues. To me, this is the number one step to making the tax system more progressive. And let me mention that there is broad agreement among economists that better funding the IRS more than pays for itself. So this is really critically important.
Yeah, Senator, I am strongly in this camp in that I'm very concerned that overall there's sort of that you don't have to pay for anything. Fairy seems to be taking over thinking and lawmakers on the idea that tax cuts pay for themselves. No, they don't. And we're going to start hearing that about infrastructure. And as much as we need to invest in this country, it doesn't pay for itself. And we've even seen studies that if you deficit finance it, economic growth could be negative. But if there's one thing that probably does pay for itself, it's funding appropriately for the IRS to close the tax gap in things like data analysis technology. And so I do think looking at this, particularly when you compare to the other revenue options, once we acknowledge we're going to have to raise revenues, it makes really good sense to start with making sure we kind of abide by the rule of law and collect the taxes that we are owed.
Ms. McGinnis, is there, as a follow-up, any specific areas of investment to the IRS to expand capacity that you would recommend or prioritize?
Absolutely. I think looking at different kinds of technology that we can figure out where the gap is likely to be, understand where we have had tax gap issues before, and enforce an audit appropriately makes a lot of sense. I also think third-party reporting will play a critical role in all of this. There's a huge gap there. I don't want us to overpromise. We're not going to be able to collect it all. People evade taxes as quickly as we can figure out how to enforce them. But there's so much better reporting now and data tracking that it will be much easier to do so.
And last follow-up question. Imagine there's a number of states that have taken this philosophy and this approach. Are there any examples, any best practices in again, investing in more thorough and equitable enforcement of tax laws and policies that have reaped good results that we should consider?
If you're asking me, I apologize. I don't know which states have the best practices. I do know we need to do a lot of updating in our states based on our unemployment issues as well. But in general, more auditors, more customer service, things that are helping taxpayers so that they don't make mistakes in the first place. All of those investments are likely to have high returns.
Professor Zuckman, is there anything you wish to add?
I think Scandinavian countries are particularly good at enforcing their tax laws, thanks to a systematic collection of third-party reported information, which allows them to send pre-populated tax returns to taxpayers. With a pre-populated tax return, you reduce evasion possibilities significantly, and so I think that's a good practice that the US should try to emulate.
White House on video.
Senator Whitehouse.
Thank you very much. Appreciate this. Thank you, Chairman. I'm sorry to come late, but we had some partisan festivities in the Judiciary Committee this morning that pulled us over the time. Let me ask Professor Zuckman, if I may. Fair to say that underreporting is rampant in our tax system and that there is abundant revenue that could be collected from simple enforcement measures?
Thank you, Senator. I think this is fair to say. According to the best available estimates, the top 1% underreports about 20% of its income. I'm not saying that it would be possible.
That was the question I was about to get to, which is, you agree with me that underreporting is rampant and that there is significant revenue to be collected from simply enforcing the existing laws, correct?
I do agree with this statement.
And then further than that, your evidence seems to show that underreporting is bigger and worse higher up the income scale than it is for people who are ordinary wage earners. Is that also true?
This is absolutely correct, Senator.
And if you are one of those high earners, what is your likelihood of being audited compared to that of, say, a poor earned income tax credit recipient? Where is the IRS dedicating its attention now?
Unfortunately, today, the likelihood is about the same. Due to dramatic budget cuts, the IRS has reduced its audit rates on the wealthy very significantly over the last decade.
And it's likely to be a slightly more complicated scheme at the high income level than from an earned income tax credit recipient, correct?
Absolutely.
So it takes a little bit more skill on the part of the auditor.
This is true.
Okay, so let's move it up one last step, and that is people who aren't just underreporting, but are actually setting up mechanisms to avoid taxes, where there's really deliberate planning underway, whether it's through shell corporations or through offshore entities or through trust devices. Is that a separate and more rampant category for enforcement?
There is significant evasion among the wealthy that involves such sophisticated schemes. Offshore wealth and income that's not properly reported, evasion through complex businesses, networks of closely held businesses, and uncovering that form of evasion requires specific resources within the IRS to fund specialized audits.
Precisely. This is the hard work. This is more complicated, correct?
Absolutely.
And with respect to shell corporations, we just gave Treasury a tool to find who the true beneficial owners are. What is your expectation about the IRS taking advantage of that information to help protect against tax evasion and avoidance?
I think there is great potential there. It is absolutely correct that Treasury and the IRS have access to more information about the owners of shell companies, about the owners of foreign bank accounts, and by putting resources in systematically using that information, it would be possible to reduce tax evasion among the rich quite significantly.
So I don't know if your expertise extends this far. This will be my last question. But let's just say that we were to crack down on offshore locations that allow people to hide their income and their assets from not just the US authorities, but from any authorities. Would there be collateral benefits to that transparency to shining that spotlight beyond just U.S. tax collection?
Oh, yes, absolutely. There would be benefit for other countries as well if there was an effort on the part of the US at fostering more financial transparency. There's a lot of financial opacity today. Financial transparency would benefit the world as a whole.
Yeah, thank you, Chairman, for this. I'll just flag, we're working on this in other committees as well, that the way that these dark economy enterprises support international criminal cartels, support kleptocrats, support enemies of our country who are planning against our country, but use the shelter of the banking system for the assets they have stolen. This goes beyond just tax collection. It gets into a whole variety of even national security implications. So I'm grateful for you calling this hearing, and I apologize again for being a late arrival.
Senator Whitehouse, thank you very, very much. Senator Braun.
Thank you, Mr. Chairman. I was in here earlier and heard part of the conversation with Mr. Hodge. I've got a question for you and then one for Maya. Coming from the world where you have to pay your bills or else you're out of business, I've noticed here from modern monetary theory to the fact that there aren't any guardrails. Don't disagree with Sheldon said in terms of getting more revenue out of what should be collected. But what I see mostly is an intractable $1 trillion deficit that we've kind of shrugged off. And I think we're right at the cusp of seeing what we do about it. Well, obviously, there's one side of the aisle that thinks we can spend a whole lot more, which will inevitably raise that structural deficit on top of everything we spent for COVID. And I'm not taking on where we should spend the money. I just like to keep the entity healthy in the long run for as many people that look to the federal government, for what they want from it. It's not a good business partner in my mind when you control your economics the way it does. I want to focus on corporate tax rates. And this would, in my mind, there's a difference between C Corps and sub-S's, LLCs, partnerships, proprietorships. That's Main Street. Corporate tax is based upon someone that is in a huge entity. It's got a lot of advantages that you wouldn't have on Main Street. When it was 35 nominal rate and taken down to 21, what was the effective tax rate? In my mind, all the research I did, it was under 21. Is that true or not? What was the effective tax rate when it was a nominal rate of 35?
I believe it was around 22%.
Okay,
It varies every year.
Yes,
Yeah.
and that's close. So what that means is that there are tons of loopholes, are things that have been built into the tax code that when you've got a Main Street business, a small one, I bemoaned every year that my marginal tax rate was about the same as the effective tax rate because you don't have the deductions. How much would we save if we eliminated every loophole or any special preference in the tax code as it would apply to C Corps, roughly?
Well, on the business side, according to the Joint Committee on Taxation's report on tax expenditures last year, there are only about $200 billion worth of, quote, tax expenditures on the corporate side of the ledger. There are $1.3 trillion worth of tax expenditures on the individual side of the ledger. A lot of the loopholes in the corporate code have been eliminated over the last few decades.
But it still would be the difference between what was a 35 nominal and a 22 effective, and you cited 200 billion. I think it makes 2 points.
With all due respect, though,
there's not as much there to bridge a $1 trillion deficit.
Not at all. And many of those, quote, loopholes are actually things like full expensing for buying equipment and tractors and so forth.
And I know we all love that in business, but we've got a crisis here in my mind that we're at probably the worst balance sheet that we've ever had in the history of the country. Back when we were about like this coming out of World War II, we were savers and investors. Now we're spenders and consumers.
Right.
And thank you for putting some light on that particular point. Next question is for Maya. Love to hear whether we've got a spending problem or a revenue problem. In a business, you've got to take care of both. And here in the federal government, when I look at the fact that revenues were going up close to 5% pre-COVID, but spending, due to mandatory spending mostly, has been going up between 6 and 7%. There's no way we ever catch up. And Maya, I'd like you to comment in two places. How much revenue do you think you could get that would be valid without starting to tank the economy? Do you think there's anything, or highlight the spending problem this federal government has?
Okay, thanks so much for the question, Senator. And sort of like fairness, there is no right or wrong in the balance of spending and revenues, but one can not deny, looking at the numbers, that both spending and revenue are on trajectories to grow faster than their historical levels, spending by much, much more. Healthcare, retirement, interest account for the vast majority, over 80% of all spending increases over the next decade. Again, people will have to figure out where they want to make those changes. But the realistic frame, and it's what I'd like to emphasize throughout this really important hearing, is that our fiscal problems are already too large to really deal with this on only one side of the balance sheet. And that is more true many multiples of time if we're talking about expanding spending further, which seems to be a popular discussion right now. It would take $4 trillion just to stabilize the debt at 100% of GDP. That's already way too much. It would take $9 trillion to bring the debt back down to balance. I doubt we'll be able to do that. It would take $11 trillion to pay for the Biden agenda. Many important things there, but we should not pretend those can just come from taxing millionaires and billionaires. So the point is, and I think it's what you're making, this fiscal challenge is huge. It's really important. It leaves us vulnerable in so many places, and we have to look at all sides of the balance sheet. But you cannot ignore that the growth in spending has been driving this for quite some time, and that will become more true with the aging of the population and healthcare costs and growing interest.
Thank you for driving home that point.
Thank you, Senator Braun. And I believe that Senator Braun is the last of our senators. So let me take this opportunity to thank all of our panelists for their testimony. And I want to thank all of the witnesses as well. All of their written statements will be included in the record as information for all senators. Questions for the record are due by 12 o'clock noon tomorrow, with signed hard copies delivered to the committee clerk in Dirksen 624. Email copies will also be accepted due to our current conditions. Under our rules, the witnesses will have 7 days from receipt of our questions to respond with answers. With no further business before the committee, this hearing is adjourned. Thank you.